Types of life insurance. There are two major types of life insurance: term and whole life. Point number 1, term life. Term insurance is the simplest form of life insurance. It pays only if death occurs during the term of the policy, which is usually from 1 to 30 years. Most term policies have no other benefit provisions. There are two basic types of term life insurance policies: level term and decreasing term. Level term means that the death benefit stays the same throughout the duration of the policy. Decreasing term means that the death benefit drops unusually in 1 year increment over the occurs of the policy's term. Point number 2, whole life, permanent life. Whole life or permanent insurance pays our death benefits whenever the policyholder dies. There are three major types of whole life or permanent life insurance: traditional whole life, universal life, and variable universal life. And there are variations within each type. In the case of traditional whole life, both the death benefit and the premium are designed to stay the same level throughout the life of the policy. The cost per $1,000 of benefit increases as the insured person ages, and it obviously gets very high when the insured lives to 80 and beyond. The insurance company keeps the premium level by charging a premium that in the early years is higher than what is needed to pay claims, investing that money and then using it to supplement the level premium to help pay the cost of life insurance for other people. By law, when these overpayments reach a certain amount, they must be available to the policyholder as a cash value if he or she decides not to continue with the original plan. The cash value is an alternative, not an additional benefit under the policy. In the 1970s and 1980s, life insurance companies introduced two variations on the traditional whole life product: universal life insurance and variable universal life insurance. Some varieties of whole life permanent life insurance are discussed below. Universal life, also known as adjustable life, allows more flexibility than traditional whole life policies. The savings vehicles, called a cash value account, generally earns a money market rate of interest after money has accumulated in the accounts. The policyholder will also have the option of altering premium payments providing there is enough money in the account to cover the costs. Variable life policies combine death protection with a savings account that can be invested in stocks, bonds, and money market mutual funds. The value of the policy may grow more quickly but involves more risk if investments do not perform well. The cash value and death benefit may decrease. Some policies, however, guarantee that the death benefit will not fall below a minimum level. Variable universal life. This type of policy combines the features of variable and universal life policies, including the investment risks and rewards. Characteristics of variable life insurance and the ability to adjust premiums and the death benefit that is characteristics of universal life insurance. Annuities basics. Annuities are financial products intended to enhance retirement security. An annuity is an agreement for one person or organization to pay another a series of payments. Usually, the term annuity related to a contract between an individual and life insurance company. There are many categories of annuities. They can be classified by nature of the underlying investment, fixed or variable, primary purpose, accumulation or payout, deferred or immediate, nature of payout, commitment, fixed period, fixed amount or lifetime, tax status, qualified or non-qualified, premium payment arrangement, single premium or flexible premium. An annuity can be classified in several of these categories at once. For example, an individual might buy a non-qualified single premium deferred variability annuity. In general, annuities have the following features. Point number 1, tax deferral on investment earnings. Many investments are year by year, but the investment earnings, capital gains and investment income in animals are not taxable until the investor withdraws money. This tax deferral is also true of 401k and IRAs. However, unlike these products, there are no limits on the amount one can put into an annuity. Moreover, the minimum withdrawal requirements for annuities are much more liberal than they are for 4001k and IRAs. Point number 2, protection from creditors. People who own an immediate annuity, that is, who are receiving money from an insurance company, are afforded some protection from creditors. Generally, the most that creditors can access is the payments as they are made, since the money the annuity owner gave the insurance company now belongs to the company. Some state status and court decision also protect some or all of the payments from those annuities. Point number 3, a variety of investment options. Many annuity companies offer an array of investment options. For example, individuals can invest in a fixed annuity that credits a specified interest rate similar to a bank certificate of deposit CD. If they buy a variable annuity, their money can be invested in stocks, bonds or mutual funds. In recent years, annuity companies have created various type of floors that limit the extent of investment decline from an increasing reference point. Point number 4, tax-free transfers among investment options. In contrast to mutual funds and other investment made with after-tax money, with annuities there are no tax consequences if owners change how their funds are invested. This can be particularly valuable if they are using a strategy called rebalancing, which is recommended by many financial advisors. Under rebalancing, investors shift their investments periodically to return them to the proportion that represent the risk-return combination most appropriate for the investor situations. Point number 5, lifetime income. A lifetime immediate annuity converts an investment into a stream of pay means that lasts until the annuity owner dies. In concept, the payments come from three pockets: The original investment earnings and money from a pool of people in the investors group who do not live as long as actual tables force forecast. The polling is unique to annuities, and it is what enables annuity companies to be able to guarantee a lifetime income. Point number 6. Benefit to heirs. There is a common apprehension that if an individual starts an immediate lifetime annuity and dies soon after that, the insurance company keeps all of the investment in the annuity. To prevent this situation, individual can buy a guaranteed period. With the immediate annuity, a guaranteed period commits the insurance company to continue payments after the owner dies to one or more designated beneficiaries. The payment continue to the end of the stated guaranteed period, usually 10 or 20 years measured from when the owner started receiving the annuity payments. Moreover, annuity benefits that pass to beneficiaries do not go through probate and are not governed by the annuity owner's will.